Thanks so much for coming back for our next edition of Econ Talks. Today I've been at Treasury's PREFU lockup, the pre-election economic and fiscal update, and there was quite a different sort of profile of expectations coming through there, Gareth. The government books being laid open and showing that although deficits are going to continue throughout, the picture in the near term is slightly better, which is in some senses exactly what we are expecting, that tomorrow's GDP number is going to be a bit better than we originally might have thought in the depths of lockdown.
Yeah, I mean, you look at some of those scenarios that Treasury published, firstly during lockdown in April and then again in the budget in May, and they were pretty pessimistic for the near term. Of course, one of the other interesting things out of those was they looked, in our view, and I think most economists would have agreed, far too optimistic in terms of the speed of the recovery. So how have they sort of changed their view now?
Yeah, so look, Treasury's view now is that things in the near term are going to be better. We did, of course, see lockdown, which didn't go for as long as we might have feared, and the economy bounced back pretty quickly with that move to level one. But the writing on the wall was quite clear that there is a worse outcome to come now for the economy sort of out into the forecast period. So 2020 looks a bit better, but we are just sort of pushing that out into the likes of 21 to 2024. And so the economic hit is elongated. Treasury now expects it takes another year before New Zealand's economic output gets back towards pre-pandemic levels. They originally thought it was the end of 2021. They're now thinking in 2022. So we've got another 2.5 odd years before the economy starts to get back to what we used to sort of see prior to COVID-19.
Yeah, so it's starting to sound more realistic. It may still be a little bit on the optimistic side. We'll have to wait and see. Obviously, there's a lot more water to go under the bridge there. So in terms of, say, the labour market, what are they expecting for the unemployment rate now?
Yeah, so look, the unemployment forecasts now are very similar in shape to ours, similar to the economic track, where things are just going to elongate over a longer period of time. And so what Treasury is now expecting is that unemployment doesn't peak quite as high. It comes in at a peak of around 7.8%, considerably better than 9 odd percent or more, but that it stays for quite a while longer. Again, I think it doesn't get below 6% up until the end of 2023. So for a lot of people out there, they're going to be looking for work, and they are going to continue to find it very difficult to find a new role. Their unemployment at a higher level means that there's quite a lot of people out there looking for work, and so the talent pool is quite good, but the amount of roles on offer still remains much shallower. And so I think what we are going to see is that people are going to start to consider their options, think where are those jobs going to be, but also what sort of skills they need to have to get back into new sorts of employment.
Yeah, certainly that had been our view, that this was a big hit to the economy. There'd be some structural changes in terms of, some industries taking a very long time to recover, or if they recover at all, of course, given, the extended border closures and the effects that is having on the likes of the tourism industry, but also through retail, for example, as well, where there's some big structural changes that have been occurring. And I think lockdown has, pushed more towards the online retailing, and we will continue to see the effects of that coming through over coming quarters. One of the other areas, obviously, that they will have been looking to shift or firm up the numbers will have been around government debt levels. If we went back to the budget in May, I think Treasury was assuming that the government was going to be spending all of that $50 billion COVID relief fund that they've set aside. We know a month or so ago that Grant Robertson came out and said, well, the government was going to keep $14 billion of that in reserve in case we, had further outbreaks. That was, of course, prior to the last Auckland or the cluster coming through in Auckland, and they have spent a little bit of that money, but there's still some in reserve. So what is that debt picture looking like now?
Yeah, so the government did announce today with Treasury that that money is still essentially on the books and allocated for spending. It's just we're not sure yet where that money will go to, but it's being kept in the books and assumed that it is going to be spent. Look, because of that worse economic picture, the net debt to GDP ratio is actually higher, peaking at just over 55% in 2024, but actual debt levels there, the gross amount of debt being taken on is slightly lower, peaking at $246 billion rather than $277 odd billion. So essentially what we're seeing is the government is still borrowing a huge amount of cash to be able to provide for this temporary spending. and that the profile over time is for it to come back. But again, that very high starting point means it is very difficult to get debt back down in any sort of short time frame. And that's one of the big, I think, challenges the government has been looking at, and actually one of the big challenges for Treasury from a forecasting point of view is trying to understand how all of these big changes and the huge uncertainty there still is around how the economy is actually going to develop. They've made some assumptions as well around the borders now opening at the start of 2022 rather than the start of 2021. So again, pushing things out by a year. And so what we seem to have with these, the PREFU forecasts, is that the hit from COVID-19 is still going to be severe. It's just not going to be quite as sharp, but more spread over a longer time period. And so what we are, I guess, expecting is that those reverberations in terms of the economic hit will continue to roll out throughout the next few years. And that does mean that we're going to be in a period of sort of persistently lower economic activity for a while yet.
Yeah, so there's still a lot of uncertainty out there. No major surprises then, I think, coming through in what the Treasury's published today. But, the fact that they've had to push back the timing of when they expect the borders to open by a year just does reflect that, COVID is continuing to affect the economy pretty significantly. And, both from an economic point of view, but also from a public health point of view, still really have no idea about, some of those outcomes over the next 12 to 18 months. We'll get a bit more of an idea with the GDP numbers tomorrow, but even there, probably the bigger question is, where does the economy end up post-lockdown? June quarter numbers will be heavily affected, obviously, by the lockdown, but September quarter should give us a bit of a better read on that.
Absolutely. And look, one of the big challenges remains that although we continue to see where New Zealand is tracking, that global economic picture remains quite difficult to pick. Treasury revising down their expectations for trading partner growth, which seems quite a fair assessment given how we've seen the globe evolve. And of course, as a small trading island nation at the bottom of the South Pacific, that does have ramifications for New Zealand's economic picture. Thanks so much, Gareth. Always great to chat, and we'll catch everyone back on our next edition of Econ Talks.